Hi guys, welcome to my channel. So before we get started, make sure to hit the like button. Also subscribe to my channel. In this video, we will talk about crypto whales explained, why investors should watch them. So make sure to watch the full video. The untethered influence of whales on the cryptocurrency market indicates that this supposedly democratizing phenomenon has become plagued by the very same problems it was allegedly created to solve. Anonymity and decentralization are the central tenets of crypto. While purporting to help the common man find economic freedom, these principles, as evidenced by the emergence and untethered power of crypto whales in the market, appear to not only mirror but indeed exacerbate the issues of centralization and inequality that plague traditional financial systems. While obviously anti-establishment, crypto is not, as will be discussed, anti-capitalist, nor is it necessarily pro-democratic. The ideological paradoxes which exist in crypto find their origins in the ideological paradoxes of big tech. Let's take a closer look. What are whales in crypto? A whale is a cryptocurrency term that refers to individuals or entities that hold large amounts of Bitcoin. Whales hold enough cryptocurrency that they have the potential to manipulate currency valuations. Crypto whales can be individuals or institutional investors. Unlike a retail investor, whales can trade over exchanges, as well as carrying out over-the-counter (OC) trades. Who are the whales in cryptocurrency? The opacity surrounding the identity of crypto whales sits in direct opposition to the transparency of the technology. Articles that attempt to answer the million-dollar question, who are the crypto whales, are scattered all over the internet, but unfortunately, linking an address to a crypto whale is nigh on impossible. While the transactions are visible, the individuals behind the transactions are anonymous. Crypto billionaires do not make up the rich lists, and aside from a few names that are frequently bandied around, including the Winklevoss twins and Satoshi, there is a remarkable lack of information available to laymen about what shadowy characters are behind these vast hoards of wealth. This anonymity, of course, provides crypto with its subversive edge, its mystique, but it also brings with it huge risk. While on the one hand unknown whales, led by an unknown pseudonymous creator, help maintain the illusion of decentralization, this anonymity, upon closer inspection, also helps solidify the centralization of wealth. As a whale, anonymity renders all kinds of market manipulation relatively easy. Whales can band together to prop up or tank the market. Whales in cryptocurrency, moving markets. Movements in the market are invariably due to liquidity. Whales, with their vast supplies, can drain the market of liquidity, thus increasing volatility. If a whale sold lots of coins, they could then instigate a market-wide sell-off. After the prices dip, the whale could then anonymously buy their holdings back at lower prices. Similarly, a whale could trigger a short squeeze, leading to an increase in price, which in turn would attract more retail investors. As more retail investors buy in, the price increases even more, thus increasing the value of the whale stock. In April 2019, for example, the value of Bitcoin increased by nearly $1,000 over the course of just 2 hours. Reports found that the reason for this sudden spike was due to the fact a single order of 20,000 BTC had been executed across 3 exchanges. This purchase had the power to change investor sentiment, leading to a rally that climaxed by the end of June. Towards the end of 2021, after Bitcoin hit the 60,000 mark in early November 2021, on-chain data suggests whales began selling up at the high again, as they constitute nearly 90% of transactions to exchanges. However, it is not just selling and buying on the part of crypto whales that can impact markets. A wallet-to-exchange transaction, for example, is when coins are deposited from a wallet into an exchange wallet. This generally means the owner intends to trade them in the short term. A large deposit of a stablecoin, however, could indicate the whale intends to purchase BTC. A deposit of Bitcoin could put pressure on the markets downwards as investors prepare for a sell-off. A large deposit of stablecoin would do the reverse. If whales withdraw Bitcoin from exchange wallets into cold wallets, this generally signals they are not about to trade them. by reducing liquidity on exchanges, price can increase. Furthermore, by withdrawing to cold wallets, crypto whales are sending signals to the market that they believe Bitcoin is worth holding onto. It is important to remember that these actions do not necessarily lead to a specific outcome. Whales in cryptocurrency can move money around different wallets to trick the market into thinking they are going to enact a major sell or purchase of BTC. It is precisely this odd interaction between anonymity and transparency, combined with a lack of regulatory oversight, that makes market manipulation incredibly easy. Speaking to Bloomberg, Kyle Samani, managing partner at Multicoin Capital, said of market manipulation by crypto whales, "I think there are a few hundred guys. They all probably can call each other, and they probably have." Similarly, Ari Paul, co-founder of Block Tower Capital, said, "As in any asset class, large individual holders and large institutional holders can and do collude to manipulate price. In cryptocurrency, such manipulation is extreme because of the youth of these markets and the speculative nature of the assets." Our retail investors also afforded anonymity. Anonymity is something of a myth when it comes to retail investors in crypto. In order to buy and sell crypto, retail investors on exchanges must undergo Know Your Customer (KIC) processes. This means that if retail investors are caught up in any nefarious business, authorities can track them down. Furthermore, as a small fry, if you are not dealing in any criminal activities and not attempting to conceal crypto wealth during a divorce, there appear to be limited advantages to being anonymous. A double-edged sword. The transparency and accessibility of the system is similarly a double-edged sword. Unlike traditional financial markets, where only experienced investors can play, in crypto anyone can. Again, for the retail investor, this is a curse as well as a blessing. The blessing of accessibility and the chance to get rich quick for a few fortunate individuals gives crypto a democratizing air. Armed with pseudo-financial knowledge from slightly dubious Twitter-based crypto experts, individuals are free and empowered to roll the dice and play the game that traditional markets have historically shut them out of. With each bull market, as more crypto experts with skin in the game encourage more naive hopefuls to get involved, the bigger crypto becomes, because every expert, whether they are a whale, a humpback, or a shark, has some investment in recruiting plankton. As one notable expert, Pompliano, recently tweeted to his significant amount of followers, every bull market has to indoctrinate the new class of crypto enthusiasts. A quick look at the social media history of Tesla CEOs Elon Musk clearly shows how easily markets can be manipulated. If Musk pans crypto, it drops. If he praises it, it rises. Given the fact no one knows which addresses are linked to him, he and other big players could be buying at the dip. We have no way of knowing for certain. In response to the phenomenon, Martin Walker, Director of Banking and Finance at the Center for Evidence-Based Management, told the Financial Times, "The brilliance of the whole crypto scam is that you don't actually have to generate any income to pay anyone, so you don't run out of money because you're making people believe in number go up. Retail investors follow the rally. Problematically, retail investors tend to behave in the opposite way from crypto whales. In November 2020, for example, when Bitcoin soared to record highs, individual investors bought BTC as prices rose and sold when they dipped. Similarly, between December 2020 and February 2021, whales increased their holdings dramatically, a trend which retail investors followed. However, between March and May, crypto whales reduced their holdings while retail investors kept plowing in. In mid-May, the price crashed, hurting retail investors who had invested when BTC was already at peak price. Retail investors, caught up in the emotional frenzy of watching their savings plummet to horrendous lows, are much more likely to sell up rather than sit on their hands and ride the wave. This means that as each low hits, the larger, more experienced investors can buy up and accumulate more. Furthermore, while institutional investors can rely on a team of analysts, experts, modeling equipment, and experience, retail investors largely get their information through social media, rendering them more vulnerable to fake news distributed through social media channels by experts who are free to say whatever will incite others to invest. Even trusted news outlets, by dint of ignorance, unknowingly prop up and give like to crypto, thus encouraging more retail investors to get involved. The BBC, for example, recently ran an article about the new Squid Game crypto and how it was surging to new heights. But anyone spurred to get involved after reading such an article would have lost all their money a couple of days later, as the unknown creators walked away with millions of dollars. An examination of crypto whales, the concentration of wealth, and the potential exploitation of the little guy to make the wealthy already wealthier, at first appears to be at odds with the anarchic, democratizing promise of crypto. Rooted in right-wing economics, however, under closer scrutiny, crypto and big tech alike express sentiments that are anti-establishment, but far from anti-capital. In fact, crypto is in some respects the quintessential expression of free market sentiment. In Stable Dematerializations, The Dialectics of Bitcoin, Benjamin Noyes, a professor of critical theory at the University of Chichester, discusses the odd ideological paradox of crypto, writing, "The libertarian politics of freedom associated with cryptocurrency is not so much consonant with a left-wing resistance to the state, but with the right-wing embrace of the market as the only determinant of human worth and nature, of course. The ongoing emergence of the alt-right, neo-reactionary thought, NRX, and the various right populisms of the present moment have all seemed to confirm the naivete of seeing the internet as a site of liberation and the hacker as the figure of subversion, or at least left subversion," Noyes continued. Such ideas are echoed by David Columbia in his paper The Politics of Bitcoin. He argues that the emergence of crypto and cyber-libertarianism is a logical continuation of the ideas established by right-wing economists like the John Birch Society and Milton Friedman. While decentralization is invariably promoted by crypto advocates as the way to free society from pesky central banks printing money and devaluing currency, it is interesting to examine the criticality of these structures in the maintenance of a stable economy. In a globalized world, a finite currency, such as Bitcoin, results in volatility due to the mechanisms of supply and demand, which drive the price up and down. Fiat currency, by altering the levels of currency circulating in the system, ensures the value of the currency remains relatively stable. Final thoughts. The existence of whales in crypto and the droves of institutional investors plowing into the crypto Wild West to hunt for yields clearly demonstrates how inequalities within the traditional financial system are not only mirrored by crypto, but in fact greatly worsened by it. Examining the possibility that crypto has become, or it indeed was always, rooted in right-wing economics, and that its emergence and surge is far from a subversion, but simply a logical extension of the next phase of capitalism, helps to frame and understand the apparent paradox of crypto whales. The lack of ability on the part of governments to regulate crypto markets signals the extent to which capitalism, aided by technological developments, has potentially begun to sow the seeds of the overthrow of liberal democracy. Such an argument, however, bodes well for the staying power of crypto. No longer a subversive, marginalized, anarchic idea, crypto, if part of the ever-accelerating forward march of late-stage capitalism, is here to stay. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.